This video is called Warren Buffett's Chilling Forward Warning for Investors in 2025.
It issues his annual letter to shareholders and shares with the world his views on the economy, the stock market, and how things are going with his portfolio. And unfortunately, in this annual report, Warren Buffett shared with us a four-word chilling warning that we all need to know. You can see here in the Motley Fool article, Warren Buffett's annual letter shares four of the most chilling words investors will ever witness. And it goes on to say, one of Wall Street's most unwavering long-term optimists just bluntly leveled with investors. We need to hear this, but first we need to get a broader context on his annual letter and some of the things that he shared, and then we'll jump into this four-word warning. Okay, CNBC Make It shares with us 3 tips from Warren Buffett's 2025 shareholder letter that can make you a smarter investor. And the first one of these out of this year's annual report is the importance of admitting your mistakes and taking sensible actions.
I was not ready for that. I was not ready for that at all. Admitting your mistakes is so important. I think that is crucial. Man, I haven't watched this yet, but this reminds me of a couple things. A handsome guy one day on Twitter wrote this post. Today is the day to take the opportunity to turn your small losses back into cash before they become big losses. Don't let this opportunity pass you by. Let me see. I don't know if I have a quote about it, but it's there is no shame in losing money on a stock trade, but to hold on to a loss and let it get bigger and bigger, or even worse, to buy more, is amateurish and self-destructive. That's from Mark Minervini. I don't have a quote of it, but there is an adage of it's okay to be wrong, but it's not okay to stay wrong. So this is great. Admit your mistakes and take sensible action. There is no shame in losing money in the market, right? It's just like if you're playing Mario, and you're jumping on the Goombas and the turtles and all that stuff, right? You're doing your thing and you die. Okay. Some of you probably rage quit and threw the remote at the screen, but that was not sensible action. And some of you, probably the ones who played it a little bit longer than that, because then you didn't have to go beg your mom for a new TV, saw the opportunity to learn from that mistake, right? Oh, if I walk in front of the mushroom guy, he's gonna kill me. If I jump on top of the tubes with the scary flower things coming out, the Venus flytrap guys coming out, it's gonna eat me and I'm gonna die. I'm not gonna do that again. I'm gonna learn from that mistake, then I'm gonna take action to not do it again. Relating that to trading, try something, right? Paper trading is a great way to start, by the way. Try something. Learn from it. Don't repeat that mistake again. Try again. That is how I crafted my trading plan, right? That's how I crafted every single one of my rules. I'm going to go up to these. Right? Every single one of my rules came from an opportunity that I took and I saw something that worked or I saw something that didn't work. And because of that, I am a much wealthier individual, and you're a much wealthier individual for the same reason. That you see opportunities, you take the opportunities, you learn from the opportunities. And at the end of the day, the only two outcomes are you either win or you learn. And by admitting your mistakes, you can get out of a trade before it completely ruins your trading account. So far, I love it.
And CNBC says, when it comes to dealing with investing mistakes you've made, Buffett recalls advice from his longtime business partner, Charlie Munger, who just recently passed away. And Munger said the cardinal sin is delaying the correction of mistakes, or what Munger called thumb sucking. Problems, he would tell Buffett, cannot be wished away. Problems, they require action, however comfortable those actions may be. So that's
Dude, this is great. I love this so far. Problems require action, however uncomfortable they may be. I'm loving this. This is 10 out of 10 for me so far.
the first one is to admit our mistakes. The second one is Warren Buffett says, don't shy away from stocks. And by this, he also means equity exposure. So whether it's individual stocks or index funds, he's quoted here as saying, despite what some commentators currently view as an extraordinary cash position at Berkshire, the great majority of your money remains invested in equities, Buffett tells his shareholders, and that preference won't change. And so what that's alluding to is Warren Buffett has been raising the cash levels at Berkshire Hathaway in their portfolio, including selling all of his S&P 500 exposure, which is a position he talks a lot about and suggests frequently for individual investors. So that's caused many of us to wonder, why is Warren Buffett raising cash? And we'll get to that in a second. And then the third piece that CNBC mentions as advice in Warren Buffett's annual letter is to go where the bargains are. And that's why CNBC says that Buffett likely isn't sweating the recent struggles in Japan. And the quote from Buffett here is, our holdings of the 5 Japanese stocks are for the very long term. So over the long term, Warren Buffett feels like those positions will reward his investors very nicely. Okay, we're going to get to these 4 chilling words, but one more article first. This is from the Tribune Chronicle, and it's titled, Warren Buffett's Annual Letter Offers Valuable Insights. So let's see what they have. First, they have a really nice quote here. So Berkshire Hathaway is one of the largest taxpayers in the United States, one of the largest payers of taxes in absolute dollars. And so the Warren Buffett's annual letter says, is a thank you to Uncle Sam. And Buffett writes, someday your nieces and nephew at Berkshire hope to send you even larger payments than we did in 2024.
Okay. I've mentioned this many times, and I think let's look at Tesla, because there were people who did this entire round trip. The stock more than doubled on the way up and gave up 100% of that gain. It was 100% up, and then it's 100% back down. Here's the deal. If you decided not to sell because of taxes, because you're a long-term holder, get out of here. Get out of here. What do I mean by that? If you are watching your stock go up, and then you get red lights, crossing under the 10 EMA. You get red lights crossing under the 20. You get red lights crossing under the 50 EMA. All these reasons to get out of the trade. And you're like, I don't want to pay taxes. And you let the fact that instead of, let's do a little bit of Excel here. Let's do a little bit of Excel. Instead of saying, you know what, my stock went from 100. No. Let's use the numbers on here. Let's use the numbers on here from 247 up to, let's say, a high of 478. 247, 478. Right. So that's a gain of how much? $231. That is huge. That is a tremendous gain right there. And let's say you got to pay 20% taxes on that. Okay. $46. $46 a share. Yeah. Nobody wants to pay $46 a share. But you still get to keep your gains. Okay? You're still keeping your gains. You still have an asset that when you sold out was valued at $478. A $231 gain. Okay? But if you held it because you didn't want to pay taxes, what happened is all of that gain is now gone. You have no gain to pay taxes on. So I am one of those people who says, I am very okay with paying as much taxes as I possibly can, because taxes are a byproduct of earning buttloads of money. Now, granted, I don't want to pay taxes. Right? Nobody wants to pay taxes. But the only way you have the opportunity to pay taxes is if you're making money. If you are watching your money evaporate, like here on Tesla, then I guess you just hate money. At the end of the day, I guess you just hate money because you hate taxes so much that you would rather not give any of it to the government, which I don't want to give any of it to the government either. But I'd rather give some to the government and have more in my account than watch this whole thing round trip back down. And there are plenty of people who did it. Plenty of people who did it. But to that point, yeah, Berkshire Hathaway hopes to send even more payments than we did in 2024. That's what they mean. Do you understand the concept here? The concept is, I want more money in my account. And by the opportunity to have more money in my account, I'm going to have to pay more taxes on it. And that's okay. And I hope to spend even more. I hope to send even more to the government this year, then the year before, and then even more next year.
And then he tells Uncle Sam to spend it wisely. Take care of the many who, for no fault of their own, get the short straws in life. They deserve better. And never forget that we need you to maintain a stable currency. And that result requires both wisdom and vigilance on your part. And that's something we're all seeing, right? With the debt at record levels and with inflation, unfortunately, starting to rise again. So those are his words to the U.S. government. We're going to get to his chilling words for us in a second. Okay. The next piece of advice from this article, the Tribune Chronicle, that they took out of Warren Buffett's annual letter, talks about on making mistakes over the years. And Buffett says that your mistakes fade away, but your winners can blossom forever. And I think there's a big takeaway for all of us in life, right? When we look back on times in our life, we're much more likely to regret the things we didn't do than the things that we did do that didn't work out, because at a minimum, we learn from that. And then when we do try something that takes us out of our comfort zone and we succeed, that can blossom for us and our families and those that we love for the rest of our lives. Okay, the next thing from this article by the Tribune Chronicle is on Berkshire's massive $334.2 billion cash pile. That's over 1/3 of $1 trillion. And it's a similar quote that CNBC picked up on. And here the quote is, Berkshire shareholders can rest assured that we will forever deploy a substantial majority of their money in equities, mostly American equities, although many of these will have international operations of significance. Berkshire will never prefer ownership of cash equivalent assets over the ownership of good businesses, whether controlled by Berkshire or only partially controlled. And now finally, what are these 4 chilling words that the Motley Fool is talking about? Warren Buffett's annual letter shares 4 of the most chilling words investors will ever witness. Again, one of Wall Street's most...
Okay. If you've already watched the video, don't answer. Don't spoil it. No spoilers. But what do you think these 4 chilling words are? I don't know. I don't know at all. So let's do this together. It's different this time is my guess. It's different this time. That's 4 words. Should. I always tell you guys, should is the most dangerous word in finance. But I'm very curious what y'all think about this.
Unwavering long-term optimist, Warren Buffett, just bluntly leveled with investors. And
okay, here we go. Only price pays. That's 3 words. Close. I like it. J-Max says it's over. Go home. Ooh, that is a chilling word. It's over. Go home. Only price pays, Chris. Take money and run. Oh, these are good. Okay, let's see what the video says.
What does he say? He says, often nothing looks compelling.
Okay. Often nothing looks compelling. That's almost like it's over, go home. Often nothing looks compelling. You know, I mentioned earlier about how I can go days, weeks, and months without trading, and I have no regrets. I do not have FOMO. And I want you to feel that way too. And how do you get to that point of not feeling FOMO? Is by having a trading plan. And your trading plan can be different than mine. In fact, I would encourage it to be different than mine. But when you have a trading plan, you know what you're looking for to get in, and you know what you're looking for to get out. And you also know you're not going to take anything that doesn't fit that plan otherwise. So by having a trading plan, you remove all FOMO. If you can follow your plan, there is no more FOMO by doing that. Golden oldie, I think this is a good one. All stocks are bad. All stocks are bad, but every once in a while they act right. That's kind of what he's saying right there. Often nothing looks compelling. And he's saying all stocks are bad. Buy the dip, bro. That's a good one. Christopher also said all stocks are bad. You got to be flipping my flapjacks. Yeah, right. Not as poetic as Alan Greenspan's word, two-word gut punch. Jeremy should be right. Jeremy should be right. Oh, yikes. That's a bad one here. But yeah, often nothing looks compelling. Means, in my opinion, just have a trading plan. And there's going to be a lot of time where nothing looks like it's set up for you. And that's okay. Don't FOMO into any trades. But often, nothing looks compelling.
4 words. Often, nothing looks compelling. And in fact, the majority of the time, nothing looks compelling. And let's see what they say. Why is that a chilling warning? When discussing how Buffett and his team invest Berkshire's capital under the Where Your Money Is subheading from the company's latest shareholder letter, Buffett bluntly notes, often nothing looks compelling. These four chilling words turned Buffett's proverbial cards face up for investors and plainly show that Buffett is struggling to find value in a historically pricey stock market. And they go on to say that being patient has paid off handsomely for Buffett and for Berkshire's shareholders. Berkshire shareholders can rest assured, again, this quote, that the substantial majority of the portfolio will be in equities. And then the Motley Fool goes on to say, put bluntly, Buffett is looking for a good deal and wants a reason to put his company's capital to work, but he's a value investor at heart, and he isn't going to chase multinational businesses higher if valuations don't warrant it.
Okay. Granted, Buffett and I are very different. But to that point, same thing. He's looking for a good deal. He's looking for something that fits his trading plan. And he wants a reason to put his capital to work. Right? He wants a reason to get in. But he's not going to chase anything higher or chase anything. He has no FOMO, right? No FOMO. If it doesn't fit his trading plan. So I think that we can make some really strong parallels here.
I think that's good advice for all of us. Have a long-term stock allocation. And when things look pricey, now Buffett is one of the world's most successful investors. So he's not necessarily timing the market, but he's asking himself, am I willing to pay the current price for exposure to a company, or am I better off waiting for his pitch? And Warren Buffett is also famous for that. He's waiting for that slow, what he calls a fat pitch, so he can swing for the fences and increase his likelihood of hitting a home run.
And you can do the same thing too. You can do exactly that. Have what you're looking for in your trading plan mapped out, written down, and do not do anything until until that thing occurs, until your signals line up. There's nothing to do. And by doing so, you can be just like Warren Buffett too. I don't know. I thought that was a pretty decent video. But who in the wide world of sports am I? Well, my name is Christopher Ewell. I've twice been awarded top honor of people in finance. I was mentored by 5 of the market wizards, the best traders of all time. I've been successfully trading since 2009, and this is where outliers like us save time, make money, and start with less risk together as a team. And I want you to go ahead and subscribe if you haven't already. So we're not going to do any more video rankings, and that's okay. But let's look at the poll of the day. All right. The poll of the day. The biggest enemy of a trader is emotion. What do you think? So we'll take a look at your results on this in just a little bit. I want you to go over to my YouTube channel, and I want you to go vote on these. So the biggest enemy of a trader is emotion. What do you think? Of course, trading is pure logic, or wrong. Even pros trade on gut instincts. Now, actually, there are several market wizards who have made a lot of money specifically trading on gut instincts. Hey, don't forget, you can save 64% on the regular monthly price by getting the Outlier annual pass over at outlier.com. That's only 82 cents a day. And if you are in the middle of your trial period, just shoot us an email that you're ready to upgrade, and we'll handle it from there. So, of course, what do you think? Go vote on my YouTube page. In the meantime, put your stocks in the chat. Put your stocks in the chat, and let's take a look at what is going on out there today. Van Man, yeah, Florida was great, but it was actually cold. I couldn't believe it. There were days where, like, we sat on the beach covered in our towels because it was windy and it was cold. And unfortunately, we weren't able to see the SpaceX lander. We tried, but we couldn't see it. There we go. Vincent first. So as Vincent has pointed out, be sure that you're putting your stock plus if you're looking at it from a long or a short perspective. So let's start with BYDDY. BYDDY. So BYDDY. We don't cover that. That's all right. We cover 2,500 stocks out there, but it doesn't look like we covered BYDDY just yet. Reason being is that we just don't have enough data for this one. Here we go. BYDDY. So you've got your 10 over the 20, price over the 50. So definitely a bullish trend. And you can see a bullish trend right there, right? Now, it did have this huge pullback here. Couple notes, right? First, you got this giant move up here, 45% move, came down, and then another giant move up right there. let's look at what I call red lights and green lights. So first off is the outlier trend template with the 10 over the 20, price over the 50. But then we can add in another layer, which I'm calling red light, green lights, when it crosses over the 10 EMA when these moving averages are crossed over. So for example, right here, all the moving averages are crossed over and it's a close above the 10 EMA. Now, why the 10 EMA? So this is a cheat sheet I want you to keep. The 10 EMA is the indicator of the short-term trend, right? If the 10 EMA breaks, that means the trend has changed directions. So you can see right here, it didn't actually close under the 10 EMA until this point here. So this would have been a green light to a red light right there. 37% gain. So even if you didn't have outlier, you still could have had a 37% gain just by following red light, green light with the outlier trend template. Again, when did it close over the 10 EMA? Well, not there. It closed under. It closed over right there. So another red light here, or green light, I should say, right there. And then look how far it's gone up. Look how far it's gone up. Now, it didn't close under the 10 EMA right there, but it came pretty close. So let's just say that that was a red light. For example, maybe you got out and then it closed right above it. So another 10% gain right there. So that's how you can do some very basic charting. Very basic charting. You don't need any other signals. You can just follow the 10, 20, price over 50, and then a red light, green light when it crosses over or under. Pretty cool, right? Here's the deal. I want to make my free YouTube videos better than most people's paid courses. So I'm doing my very best to deliver to you the very most amount of value that I can. So even though we don't have this in outlier, I still want to make sure that it works out well for you. So thank you so much for that. I really appreciate, who was that? Let me scroll up. Vincent, I really appreciate you with that one today. Ween wants to look at CCI long. So let's go to CCI long. Let's go look at CCI. Okay, so we got this buy signal back here on January 21st. You've got 10, 20, 50. They're all crossed up. Now, it took a while before that actually crossed back up, but that's okay, right? You still could have got in down here, or you could have waited to get that green light on this side too. Either one of those are good opportunities. So you've got your green light over here, and it moved up quite a bit from around $95 a share to $110 a share, or $105 a share. The stock itself is getting a lot more greedy, a lot more greedy. It's up at 76 today. And then the real estate sector, however, has been getting less greedy, starting to move towards fearful. So this one looks really, really sharp. Of course, just make sure you keep your risk in check, but that's a great one right there. Knight wants to look at AMD. Now, this is a great opportunity to show a buy signal within a downtrend should not be considered a buy to go long. A buy signal within a downtrend, so your sell signal came here. That could have been a sell to go short signal if you want to look at it that way. A buy signal within a downtrend would be a buy to close signal, not a buy to open. And it's continued to go down. As you can see here, the fear has gotten as far as 23 out of 100. But it's actually crawled back up. In fact, it's up at 30 right now. If we throw the 10, 20, 50 on top of it, we've had a couple of closes over the 10 and a couple of closes over the 20, not quite to the 50 yet, but it looks like the short-term trend may be starting to reverse. And then even the tech sector is starting to get a little less fearful. So AMD itself, a little less fearful, the sector, a little less fearful, and crosses over the 10 EMA right here. You never know. AMD might have hit a bottom. We have to see. But of course, always keep your risk in check. I'm curious about the DG, Dollar General. Emmanuel wants to look at it from a long position. All right, we got a buy signal here. In fact, let's do this. I'm going to hide a couple things. We're going to hide market breadth down here. Hide column 2, hide column 1. Now, we will be making these sticky. I believe when I go to the next stock that my view might change back to the other way. But sticky profiles are coming really soon, as well as all the brand new charts are hopefully going to be done the next 2 to 3 weeks. But we got this buy signal that came through on March 12th, and you can see it was around 66 on the greed right there. And it's been going up since then. The greed has been going up as well. You've got it up to 72 right now. Let's throw the 10, 20, 50 on there. So yeah, from a long position, that looks really good. The stock itself moving up, the greed value on the stock moving up. However, the staples sector is getting a little less greedy. Now, this makes sense to me, and let's talk about why this makes sense to me. So, as the market seems to have found a temporary bottom here, the staples sector, staples meaning things that people go to for common goods like Coca-Cola, PepsiCo, Lay's, things that Dollar General, things at Dollar General, right? Those kind of things you'd find at Dollar General would fall into the staples sector. This is a defensive sector. So when the market is weak, staples generally make up for that. Staples generally are where people rotate to when the market's weak. And you can see here, the whole sector, however, is getting less greedy. And that makes sense if we found a bottom right here. So that was a great opportunity to talk about that correlation right there. So Emmanuel, DG looks pretty good, my friend. Looks pretty good. Philip says, hate to say it, Chris, but my gut never lets me down. Let's look at long GLD. How would you get in on an ongoing trend? Wait for it to dip below on a 10 EMA and above again? Thoughts? Okay, let's look at GLD. Oh, the profile stuck. Perfect. So GLD got that buy signal on the 21st. So I guess that was last Friday. So this is actually a signal I would be interested in. In fact, let's go with the 10, 20, 50. You've got the greed, got as high as 88, 89, and then it came down. And now the greed is coming back up again at 69. And everything in the metal sector, it looks like, is also getting more or less fearful, a little bit more greedy. So it's okay. It is okay to pay up GLD, right? Can you wait until it comes back down to the 10 and then crosses back over? Absolutely, right? Imagine this could be your green light right there. But here's the other problem with that. If you do wait, let's look at this trend right here. The green light came here. And this is one of those big advantages with outlier that makes it a lot easier to understand when a good entry point is and isn't. Because if you're just following technicals, you've got your 10, 20, 50 green light on this candle right here. But let's say you're a couple of weeks late and you're like, oh man, I can't get in right here, right at 253. It just went from 244 to 253. I can't get in right here. It's too high. And then what happened? It kept going. And now you're looking at it at 261. And you're like, oh man, I can't get in at 261. It's too high. I could have got in at 244. And then it continues to go up and it's up at 270. Oh man, I can't get in at 270. It's too high. I could have got in at 244. And then it comes back down and you get another green light. Let's use this one right here. And now you're on this side and you're like, well, I mean, that is 269. That's a lot higher than the 244 it was back there. Should I get in now or should I wait until it comes back down to 244? And then what happens? It goes up to 280, right? So a couple things with that is Mark Minervini. In fact, if you go to my channel and you go to the playlists and you go to the Market Wizards playlist, and I believe it's this one here. If you go to this video here, Achieve Super Performance, Minervini and I had this conversation. He's like, listen, there's a chance that it's never going to come back ever to that price that you could have got in had you followed your signals. That's the important part. Follow your signals. So there may be times where you have to pay up, and most people won't do it. Most people won't pay up because they think, oh man, 256 is so expensive compared to 244. And then what happens? They look at 272 and they're like, man, 272 is way too expensive. I could have got in at 256, and they never get into anything. So having those plans in place makes it a lot easier. And then, of course, getting that buy signal from outlier makes it a lot easier as well, because not every trade is going to work out, but it does put all the confluence in your direction. And even when it is a bit higher than your 10 EMA, that's an opportunity to get in, my friend. So great question, and thank you for allowing me to take a look at that. Let's look at BA long. All right, so Boeing long. Yay. So some of y'all know I used to work at Raytheon, and the projects that I worked on were the Predator and Reaper drones. And I worked specifically on the missile targeting systems, the little ball sack that hangs underneath it. So I worked in the finance part of that, and super interesting. While we were in Destin last week, I didn't realize I was close to Elgin Air Force Base, and we saw F-22s, we saw CV-22 Ospreys flying by, which were my personal favorite. I never got to work on that project, but I have friends that did, and I always thought it was really cool. We saw C-130s fly by. We saw some Coast Guard helicopters fly by, right? I love all that kind of stuff. But Boeing has not had the great reputation lately. In fact, that's why those astronauts were stuck up there for 8 months, is because NASA was like, we can't send them back on that Boeing ship that took them up there. We don't trust that. So yikes. But anyway, taking a look at this, we got a buy signal on Boeing just a couple days ago, this last Friday. The fear and greed sector is moved up to fear and greed heat map up to 43. The sector itself is getting less fearful. Now, keep in mind, when the market is weak, that makes things harder. That makes things harder because 40% of any move is due to the market. 30% is due to the sector. And the last 30% of any stock's move is due to the stock itself. So this could be a lot stronger if the market and the sector were also pushing with it. But dude, yeah, from a long perspective, from a long trading perspective, looks like your 10 and 20 might cross today. And it could be all set to go. So I actually like Boeing from that perspective. I may not want to ride on a Boeing, but I like it from that perspective. So great question on that one. Let's go back to this poll and see how y'all voted here. How did y'all vote? The biggest enemy of a trader is emotion. What do you think? Of course, trading is pure logic. Wrong. Even pros trade on gut. All right. In my opinion, I'm going to make a vote here. I would say trading is pure logic, but it's hard. It's hard to remove the emotionality of it. In fact, that's why I made this slide in particular. And why when I'm trading, I want to go through this with you every day. This is trading psychology in a nutshell in 3 points. There are no expectations for this outcome of a trade, right? There's no expectations at all. I can't say when I buy the stock, it's going to go up to $50, $100, $150 a share. I don't know what it's going to be. And for the YouTube gurus who come out there and they're like, this $75 in this one stock will make you a millionaire. Give me a break. You don't know the future, right? And because we don't know the future, you shouldn't set expectations on the trade. When you set an expectation on the trade, you emotionally anchor yourself to that point. And by emotionally anchoring yourself to a point, what are you going to do when it never reaches that? What are you going to do if it gets to your target was $150 and it only got up to 75? Are you then going to hold it for years? A lot of people do. But you don't have to do that. You don't have to have a profit target. You don't need an expectation and you don't need a profit target. You don't have to know what's going to happen next in the market, which took me a long time to overcome because it's like, how do you make money if you don't know what's going to happen? The way you make money is you have a plan to get out when one of your exit signals happens. Right? This is admitting I don't know what's going to happen. This is saying I don't need to know what's going to happen. I'm going to follow this plan no matter what. And there will be times where I have big winners. There will be times when I have small winners. There will be times where I have break evens, and there will be times where I have small losers. And that's okay. But there will never, ever be a time where I take a big loser. Because I know A, my position size, and B, where I'm going to get out if I'm wrong. And in the meantime, I don't have to know what's going to happen. I don't have to know at all. So I would say, of course, trading is pure logic, but it's difficult. It takes a lot of emotional work, a lot of self-work to get to that point. And 92% of you agree. That's pretty cool. Very, very cool. So listen, I am super stoked to be back here with you. And listen, I'm not going anywhere except for tomorrow. I'm going to be out tomorrow, but I will be there. I will be here this afternoon. So be sure to come back to this afternoon's live stream where outliers like us will save time, make money, and start with less risk together as a team. YouTube is going to pop up a couple recommended videos. I recommend you watch one of them, and I also recommend you come to this afternoon's live stream. Thank you so much for being patient with me while I was on vacation, and we'll talk soon.
10 over 20 over 50.